Hi everyone. I hope this finds everyone well. What we're going to do with this month's webinar is we're going to talk about the potential crash. Everyone always asks this question whenever they're about to buy property or any investment. To be honest, come to that, you tend to find the first question on everyone's mind is essentially, are they buying at the right time? So I'm going to turn a few things off my end so we don't get disturbed. Cut a long story short, we've been having this for years. This particular question is constantly asked of us, and I remember back in sort of 2013, 2014, when the market was getting pretty hot. We had a lot of clients at the time all saying the same thing. They're about to buy, and their last little niggly question at the time is, look, what if the market crashes? What if it dips? And our answer is the same all the time. Look, we can't predict exactly what's going to happen. We can't guarantee that it's not going to dip. But of course, in regards to the fundamentals, we don't anticipate that they'll change. And we're going to come to the fundamentals in more detail later. But just so you know what the fundamentals are, there are three main fundamentals. They are taxation, which is things like your stamp duty that we've seen change. Legislation, so if they change the laws in terms of, if they suddenly said, well, you can only buy one additional property, you can't buy 2 or 3 additional properties, again, that would have a dramatic impact. And mortgage rates / liquidity. So the moment that you see mortgage rates differ in terms of interest rates going up or down, and the moment that you see liquidity change, whether they're lending more or lending less, those things are what affect the property market. So they're the fundamentals that we always refer to. All the other stuff is pretty much superfluous in regards to whether you think about Brexit, elections, COVID, all of the other stuff that the papers report that's going to have an impact actually doesn't. What does is simply the three main fundamentals. So let's delve in. Let's have a look. So first of all, we have to look at things about the right time to invest. Now, I'm going to bring up the FTSE here. This is the UK stock market. Now, the reason I brought this up is because the FTSE is far more volatile than the property market. The reality is, you can probably make more in a short term in the stock market than you can in the property market. But the same goes the other way. You can also lose a lot more short term. So we typically say to people, the reality is that the property market is a more solid bet over a longer term period. You don't have to worry about these fluctuations. But look, let's look at the FTSE and let's look at what happened. So you can see here the dip. Now this was obviously back in March last year, April last year. The majority of people who waited and said, you know what, I'm going to wait for a crash, I'm going to wait for a property market crash, I'm going to wait for a stock market crash, had the perfect chance in the stock market to get involved at this point here. It went from over 7,000 points to 4,994, give or take. It was just shy of 5,000 points. But I can guarantee the people that waited to buy into the FTSE, and when it dipped to 5,000, their mentality restricted them still from buying. Because what we tend to find, and what we speak to, you don't just speak to economists about this. There's another type of economist, which is a behavioural economist, and they're people that look at people's behaviour. And behavioural economists look at things like trends, where you tend to have clients, they're part of a herd rather than they lead from the front. They're part of a herd. So typically, when everyone's getting out of the stock market, that's when it's falling. Obviously, that's the reason why it falls, because everyone's selling. It doesn't get out for any other reason, bar the fact people are selling off. So when the stock market falls, the herd is actually going the other way. The herd is actually selling. So what tends to happen is people wait, they don't buy, and it's only when the big institutions start to get back in because they realize that it's cheap that things start to go up. And then what happens is your amateur investor gets in, and they probably bought back at 6,500 when they could have got it at 5. They thought that it was still going to be dropping. So we're going to come on to mentality a little bit later on, but you typically will find, even in a crash, you won't have the people that are waiting to buy, you won't have them buy. They'll still wait, and they still probably won't have anything. We have got clients actually going back to 2013, 2014, and they're still requesting information on products, I'm sure they won't mind me saying, but they missed an opportunity. There was opportunities at the time to get stuff in Manchester, for example, in Media City, one beds for 95,000. They're now 160, 170,000 pounds. So what we tend to find is those people have never bought. They had the chance then. They're probably outpriced the market now, and they still are looking for that right opportunity. But mentally, they won't allow themselves to buy. And typically, what's happened is the majority of people that we spoke to that had money at the time, they had it in your typical premium bonds investments, or just a basic ISA or something like that. They didn't have the kind of investments that could make them the kind of money that they really wanted to make for retirement, for kids and university funds and whatever it may be. So moving on from the stock market, as I say, we're going to come back to mentality a little bit later on. But moving on from the stock market, we're going to look at really, you want a 10-year plan. You don't want to look at short-term plans. Typically, investment-wise, the short-term plans, they don't work. It was Warren Buffett said something along the lines of, if I don't like something for 10 years, I don't look at it for 10 minutes. The reality is any short-term plan, guys, especially in the property market, won't work. So if you're looking to flip a property within a year and get your money back, there are so many other variables. I would say, unless you're looking at it for minimum of 5 to 10 years, I wouldn't bother with the property market at all. It doesn't pay off unless you're really going to start to look long term. So what we look at is when we're investing, or when we're advising to invest, is transportation and plan new links. So we've all heard about HS2 heading into Birmingham, Manchester, Liverpool, and hopefully heading on to Leeds. We've heard closer to the London area, we've heard about the Elizabeth line, or Crossrail as it's called. It's going to be Crossrail 2 and so on. But we also look at other things in the areas in terms of not just national, but also local as well. So we look at local transportation. So for example, in Manchester at the moment, although that they've got national rail and HS2 coming in, we look locally, what tram stops are they building? So there's a tram stop 2 or 3 years ago that was built on the river. So we know that actually that's probably going to be a decent place to buy, which we did. We bought in 2015, 16. Clients were getting, again, one beds on the river when there wasn't a tram stop for 160. One beds are now 210, 220 in there. Again, simply because of obviously river frontage and especially due to that new tram stop. We look at local industry as well. You may have a particular property or an area even, which is going up great guns at the moment, but if they don't have some solid industry, or they don't have a good solid demographic behind it, that can go up instantaneously. And we only have to look at areas, this is going back some time, we only have to go back to these sort of like 1970s, 80s, when you had whole areas in Wales where they had miners, and the industry in the area will be thriving due to miners. The moment the mine closed, the area was dead. We don't want to get in areas like that which are dependent on one industry, and this is why we always say city centres are going to be far better than second or third cities, because they tend to have a better demographic. They tend to have universities, and again the retention rates, which we'll come to in a bit, but the retention rates of the students in those areas is high, so there's a constant pressure on housing. And this is why if you look at the UK for the last decade, you'll see that the best places in terms of property growth and yields have just simply been London, Liverpool, Birmingham, Manchester, Leeds, the city centres. So we look at local industry and what's happening there. Planned regeneration, we look to speak to councils as much as we possibly can to see where money's being spent. When these new developments get built, they typically have to have affordable housing in there. However, there's a way around that. They do what's called a Section 106, and they pay a sum to the government, or to the local council, I should say. And typically those areas get spent, or that money gets spent in certain areas. So we will always speak to local people in the area where money's going, because there might be a plan to build up a particular area over a 5-year period. Let's take Liverpool. There was an area in Liverpool called Baltic Triangle. It was old warehouses, run down, no one was in it 10 years ago, but the local council had an idea that they were going to get these local warehouses and these local brick built grade 2 listed buildings up to scratch, and it was then voted one of the best places to live in the UK. And again, the property prices went through the roof. So we look at the demographic there as well. Now this goes on to your personnel. What's the affordability like? What's the crime rate like in the area? All these things add up, and it's stuff that we take into consideration before we make that recommendation. And of course, as I sort of touched upon, the education side, the schools, because if you've got good schools in the area, and you've got good universities in the area, you're going to attract a lot of students, and it's the students that actually put the pressure on the market. Because if you've got sort of like in Manchester, where you have 55% of students remain after they graduate, then you know that there's going to be fantastic pressure on the property market. Suddenly they will rent for X amount of years, they will then become first-time buyers, and up goes the chain. So that's really what we're looking at. So as we then move on, we're going to sort of look at what has happened over the years as well. Now, this is on our website, so if anyone wants the link, let me know and I'll send it to them. But this is on our website now. You can get this. It's on our blog. We did this last year. So when we look back to, is the property market going to crash, or when potentially is it going to crash, then we have to look at the headlines from the last 20 years. Now, we wrote this a year ago, so this is not something that we sort of said in hindsight. This has been on our website for a year, since June last year. And you can see that we're trying to separate fact from fiction, because at the time, there were so many headlines due to COVID that the property market was going to dip. So what we wanted to do is, show that actually we've always got these headlines. So you can see here, the Daily Mail reported in sort of 2001, house prices sure to plunge. And then we had another 2002, house prices to fall 30%. Again, 2001, 2002, right the way through to 2008 was a great time to be involved in the property market. So in terms of those particular headlines, they were totally inaccurate. We then had this particular guy here. Again, he actually did an article, and he actually did a case study where he sold his property. He was so adamant that the property market was going to fall. He actually sold his property, rented out, because he thought that the prices were going to drop dramatically. But what actually happened is, the end of the case study, he found out that he had to pay an extra 60% for buying the same property back that he sold. So again, it just didn't pan out. And we then head on to what the economists and agents and the Bank of England, importantly, we'll come to the Bank of England, but what they were saying back at the start of COVID. So essentially, we had Knight Frank that was saying it's going to dip 3%. Zoopla, fair enough to them. They said it's impossible to say. Savills was 5% dip nationally. Lloyd's 2.2% dip before bouncing back next year. And the Bank of England, bizarrely, 30%. I've never seen anything, like a headline from the Bank of England as bad as this. It was 30% up to 30% falls. Now, this is the paragraph below is what we wrote at the time. We said that it was, first of all, it was irresponsible of them to say something like this, but actually they're pretty renowned, the same as the IMF, for getting things drastically wrong. But they've always got the get out, and we put this paragraph in there, we put the sentence in there, because when it doesn't happen, which we didn't think it would, even in its worst, it never fell 30%. But we put this in there because what they state is, when it doesn't happen, they then turn around and they say it was because of us. It was because of our policy. Now this, they wrote 30% back in sort of May, June time, 2020, when we did this particular article. Lo and behold, in May this year, 18th of May this year, the Bank of England come out and said that they prevented a financial meltdown. Now, it's just the same thing every time. They said it the same with Brexit, that if we vote to leave, X, Y, Z will happen. Then they said that they prevented that. And they've now said that they prevented the financial meltdown back at last year. Now, the financial meltdown was one that they said where property prices could fall 30%. So again, I think both things are irresponsible. Did they help restrict the financial meltdown by printing money? Of course, but I don't think there would have been a financial meltdown anyway. The reality is people have got £250 billion extra in their pockets due to either not going out, not commuting, and not having to pay mortgages, having mortgage holidays, things like that. So the Bank of England have come out and said, actually, clients have got money, or people have got more money in their pocket. There's £250 billion extra within people's savings accounts than there was this time last year. But the Bank of England, pretty irresponsible to say things are going to drop 30%. But as I say, they say this very often because then they come and save the day, apparently. Now, in terms of the fundamentals, as we spoke about the taxation, the legislation, and the interest rates and the liquidity. And throughout all the reports that we've gone through on the previous slide, we haven't had that crash that they're predicting. So that brings us back to obviously the main question: when do we think it's going to crash? Now, the last two major crashes have been the late 80s and 2008/9. Now, the late 80s had skyrocketing interest rates. I mean, especially people who weren't around in that particular time or don't remember that time. When I speak to some of the staff at work, when a lot of them are in their sort of like mid 20s, and you say, look, we had interest rates of 16, 17%, they just simply don't believe it. That actually at the time people were kind of paying that money back in terms of loans. But that was the reality of it. People couldn't afford the mortgages, so they literally handed back the keys. Similar thing in 2008. Slight difference was that we didn't have those kind of interest rates, but we did have a lack of liquidity. So the lack of liquidity simply meant that if banks didn't lend, and there was a multitude of factors for this, including mistakes made by the government at the time. Gordon Brown made a few comments which really put a dampener on the property market. But at the time, there was a lack of liquidity. If banks don't lend, the whole mortgage market simply collapsed. And that's why we had the kind of crash that we did. And again, let's take the recent boom. Let's take the recent boom that we've had. Part of that has been due to the fact people have got more money in their pockets. It's been a perfect storm, really, because people have had more money. People have wanted more space, and we'll come to the more space subject in a minute, because it isn't just more space, doesn't only mean a garden, but people have wanted more space. Plus, on top of that, there's been the stamp duty holiday. So again, that relates to the taxation side of things. So taxation has eased up. So it's been this perfect storm where clients have been able to get more hands on their money. Taxation has meant effectively, even if the property price has gone up, they've saved on stamp duty. So therefore, it's created this great opportunity for clients to buy. And now we then go back to the behavioural economy side, where once the ball starts to roll, the next batch of clients come on and think, well, we better get in because the property market's going up. So they maximise the price of their house. They then pay a little bit extra for the house they're moving up. They upgrade, and then suddenly the process starts again. What you then find is the next batch of people think we better get involved before the property market gets out of control. And so the process goes on. So you have this behavioural economics where people are following the trend rather than actually thinking logically what's going to happen here. So in terms of our predictions, which is the key to this webinar, excuse me. So we think we're going to pretty much have the same rate of growth for the next number of months, because taxation is we've still got the stamp duty holiday. Legislation isn't changing, and interest rate / liquidity we feel are going to be pretty much the same. So we think that up until October we will have the same rate of growth as we're having now. And in terms of that particular growth, as I say, we're seeing 6 to 6.5% in Liverpool and Manchester respectively, all the way down to London where we've got 2% growth. But the reality is you're still better to buy up the north unless you find a good opportunity in London or within a half hour, 45 minutes train ride from London. Now, from October, taxation will change. The stamp duty will be taken off. And then so suddenly we think that that's going to have an impact. But we do still feel that on average 3 to 4% growth in some of the better cities is to be had, because mortgage rates, 95% mortgage rates we can get. So this is where we look on the third fundamental, which is interest rates / mortgage rates, liquidity. If you can get 95% mortgage rates, you can have a lot of first-time buyers get on that ladder, and that pushes everyone else up the chain. So we still think for a couple of years, there's no reason why we shouldn't have 3 to 4% growth. Then after that, we expect it to peter down slightly from 2024 onwards, around 2 to 3% growth. Like we said, we think there's going to be a slowdown in growth, but we still think there's going to be growth. Now, if you add that onto your 5-6% in terms of your income, you still got really good investment there, giving you sort of like anywhere between 8 to 10% on a traditional let. However, if you do a short-term let, where staycations are really becoming a lot more popular, as some people don't want to travel abroad, they want to stay in the UK. Staycations becoming a lot more popular. You could really start to put that income up to 8 to 10% with your growth on top. You could easily be making double digits there. So as I say, we feel that the property market is still there. We haven't changed. We've not been chopping and changing our ideas. We didn't think it was going to fall after COVID. We did a webinar. We put ourselves out there and said we don't think it's going to fall at all. We think it's going to go up. We didn't predict the kind of growth it has done, the 6% plus. But we still felt that there was a good, strong market. But another big factor, guys, at the moment is mentality. And as I say, I know I keep saying about behavioural economists, but this is what they call the fear of missing out. The moment people have a fear of missing out, they jump on the bandwagon and everything starts to go up. Everything starts to push on. So when will we see a dip? And we will see a dip. Let's be clear about it. We're not the type of company that will say, yeah, you're just going to have the next 20 years of growth. It won't happen. There will be a dip. Like there was a dip in the 80s, like there was a dip in 2008, 2009. We will see another dip. Do I think there's going to be a crash? No. Do I think there's going to be a dip? Yes. The reason being that I don't think there's going to be a crash is that it's the way that they have been printing money globally. And we're not just talking about the UK printing money. I mean, you're talking about trillions being printed globally. To put interest rates high, and why they typically will increase interest rates is to calm inflation down. But typically, if they did that, it wouldn't just impact the property market. There would be a global recession, and it would probably be a lot tougher than what it was in 2008, 2009. That's the reality of it, because there's probably a lot more debt out at the moment now than there was then. So I think they've learned their mistakes from that, and they will probably let inflation run hot rather than actually putting interest rates up to where people can't afford mortgages and can't afford loan repayments. And that it doesn't just affect mortgages, it's cars. You know, most people have got mortgage repayments on furniture in their properties. They've got credit cards, all of those kind of things people would struggle with. And suddenly it has a huge, huge impact. So I think after 2024, we're going to see maybe a slight dip of where the market has to pull back slightly. Again, I'm only thinking in the region of sort of 1 to 2%. And what typically happens is you start to just see offers. If a property is priced at 300,000, and in this current climate, someone would offer 310, 315. In the current climate I'm thinking of, it'll be 300, and they'll bid 280, 290, and maybe get it for 290 or 295, something like that. So we're only talking about, you know, a few percent in terms of offers being made, and then that drags the property market down slightly. But I certainly don't think that we're going to see this this crash that people have been looking at. I think they'll let inflation run hot before we start to see the interest rates get to where it could be a little bit precarious. But the time when they get to 2 or 3%, guys, is the time when you've got to start thinking that that's not a time to get out of the property market, but a time to maybe make some decent offers. If we start to see interest rates back up to 4 to 6%, that's the time to get out, because that's when you'll see mortgage rates really start to increase, mortgages become unaffordable, house prices start to really sort of crash at that kind of level, especially if mortgage rates start to, peter up to 6-7%. That's the time, guys, when you want to sort of reassess the portfolio and what you should do with things. So that's our prediction. And that's it, guys. In terms of the next steps, as I say, you should have speech bubble question marks where you can ask questions. I did get asked a question via email before this. So I'm hoping that answered it for you in terms of when we expect and what we expect to see happen. And a lot of people say, well, what is if there is a dip, should we wait? But again, typically, if you waited in 2006 or 5 or 6 and you waited for the dip, the reality is if you bought in 2005, 2006, you'd have actually come out of that with more money anyway. So even if there is a dip, and however large the dip is, the reality is that if you hold the property for long enough, you will still come through the other side. So we advise that it's all about the here and the now. Don't think what could happen. It's about here and the now. Can you get an investment, whether it's the property market or any other market, that is going to outperform where your money currently is? If the answer is no, you leave the money in where it is. If the answer is yes, then you make the move. So got some questions coming through. Do we have a mortgage advisor for new build buy-to-let flats? Yes, we do. Going on to mortgages, mortgages are tougher to come by than they were. It's not to do with liquidity. It's not to do with the fact that they don't have the money to lend like it was years ago. It's more to do with the fact that they're being really picky. So on new build flats, they're asking, for example, what's the percentage investors to residential clients? So that's why we always say avoid the guaranteed rental schemes on anything that's residential. So it's fine on student properties, but if you're looking at stuff that's residential and they have a guaranteed 8% or 9%, whatever it is on there, typically you're not going to get a mortgage on that. Now, if you're buying cash, you think it won't affect me. But the reality is when you go to sell it, it will, because you're narrowing down the market in terms of who you can actually sell to. So I certainly wouldn't be advising anything where you can get a residential and guaranteed schemes. unless you're buying something sort of 60, 70,000 or student properties, something like that. Because you need people, when you start talking about 120s, 180s and that kind of money, people need to get a mortgage typically, so you don't want to narrow down your market to sell. Stamp duty, do I see another extension? No, I don't. As I say, we did a webinar just before, I think February, I think it was, and we felt there was going to be an extension there. But this one is a definite no. There's no advantage to them. What we've got to understand as well is they make a lot of money from properties being sold. Properties being bought and sold is a great, not a hidden tax, but it's not. Whereas income tax, you always see it as it's directly impacting your income. With stamp duty, you don't, because typically people add the stamp duty to their mortgage, so they actually don't think of stamp duty as a tax, but it's a chunk. There's people out there that I've got dealing at the moment, and they're about to do 40 or 50,000 in stamp duty. That's a tax. So they won't waive it again. I don't think they're going to extend it again at all. They've got part cut off coming up soon in July, and then it tapers down into October. I think that's it then. I certainly don't think they're going to be extending it again. But on the flip side, they don't want the property market to suffer, because they want the property market to keep, pushing forward, people buying and selling, because it does bring them in a lot of tax. So as I say, I don't think they're going to extend the stamp duty, but at the same time, I think it's a positive that they want to really motivate the property market. So what's my view on post-coronavirus recessionary factors? Government support for the virus will have to be paid for somehow. Yeah, it will. Maybe not now, maybe by my kids potentially, but yeah, I think that they've been printing money for years. They really did a lot of quantitative easing back in 2008, 2009. It will have to be paid for, but typically, as I say, that we don't. It's not like it used to be. We don't have countries and governments balancing the books anymore. The debt is just spiraling, and actually, it doesn't really impact, because they can theoretically just keep printing and keep printing. As long as inflation is curbed, they can just keep going with quantitative easing. However, yes, you're right. It has to be paid for in some way, shape, or form. Are they ever going to pay off their debt? Certainly not. There's not a chance that the amount of money that they've printed, we can get back to that zero debt. So all countries are going to run a debt. It's just how clever they are with running the debt and how things work there. So no, I don't think that they're ever going to pay it off, but I think that there will be some struggles ahead in terms of maybe my latter years at work, but more in my kids' side of things, where they're going to be impacted typically by things like I think their pension will be non-existent at the time. I think if you have other pensions, I think the state pension will be gone. So I think that will be a chunk to come off the debt. Whether there's a state pension when I retire, I don't know. But I think certain things like that, I think will be indirectly rather than directly. And before the boom, the majority of the offers were below the asking price. Now they're all higher than the asking price. Yeah, that's right. When should this drop to reality? Well, okay, so going back to your last question, when should it drop to reality? Well, the reality is what people are willing to pay for it. So what the prices are now are real. It's not as if that they're making fake prices up and not getting them. These prices that they've put up, they're achieving them. So the higher prices have become the reality. So going back to what we spoke about earlier, well, your house is only ever worth what someone is willing to pay for it, is the old adage, and that's the truth. That is the reality. If someone, if you've got a house and it's 500,000, but someone pays $1 million for it, the reality is your house is now worth $1 million because someone has paid for it. So people are getting carried away. We're actually having offers when we've only got, for example, there's a development we had last week. It was priced up at 220,000. Pre-COVID, we would have had offers for 210. Post-COVID, we're getting offers for 240. People, there's one left that's ready now. They're chomping up the bit, and they're putting 10-15% on top. So do we advise that? No, we advise that people pay undervalue, because that's where they're going to make the most for an investment. But we have a lot of residential clients as well. They just pay over the top because they like it, they want to get in, and it's tough to get something ready now. Excuse me. So as I say, I personally don't think we're going to see any kind of reduction in anything major at all. You're going to have the odd offer here and there, but any major reduction until we get another 2-3 years out of the way. Has the current cladding issue increased or reduced demand for newly built flats? Yeah, it's a really good question. It's done a number of things. So what cladding has done is it's actually increased the demand for newly built flats because, ironically, let's say you've got, again, let's be really crude in terms of our numbers about this. It's very basic calculation. Let's say you've got 100,000 flats in a city centre that people can move around in, and there's demand for 100,000 flats. Well, let's say suddenly that the government announced its cladding legislative changes, and that's where we come back to the legislation side of things. They announced about the cladding, and then suddenly there's only 50,000 of those flats that can now get a mortgage because the rest are effectively, in the lender's eyes, worth zero. Well, now we've got 100,000 people, and 50,000 of those can't sell their flats. So what then happens is they're stuck because they can't move. But when the new batch of first-time buyers come in, they now have less of a pot to choose from. They've only got now 50,000 people to choose from. So that then puts pressure on the new build flats. And then also what adds to that pressure is some of these new build flats were delayed due to COVID. They were delayed due to planning because the councils weren't in. So there's a lot more pressure on new build flats. However, and there's a caveat to this, is they've got to be new build flats that meet the current regulations, because a lot of these flats which were half built a couple of years back and then they carried on building them with cladding. Now, although that the cladding wasn't like the combustible cladding, they had different ratings on the actual form. So this EWS1 form, which is the external wall safety form, they have like an A rating and a B rating. So you might have A1 rating, which is what you want. That's no cladding anywhere. But if you've got a B1 rating, it means that there is cladding, but in their eyes, it's minimal enough to warrant any kind of issue at all. Now, that's fine. But a lot of these lenders are taking it to the extreme, which is putting more demand on not just newly built flats, but any property at all. But what I would be advising everyone is look, the reality is any flat that we complete on now, we make sure that they've got the latest regulations. Anything after the 2018 regulations is key. And it means that you're going to be protected from any kind of cladding. Well, look, guys, it's been a pleasure as always. I hope you found this useful. And what I would say to you is you've got my email address here. If there's any particular subject that you want, anything at all for next month's webinar, just let us know and we'll cover it. Alternatively, if you've got specific questions that you'd like to ask us, again, let us know. And we'll sort of we'll just have a webinar where it's just literally a question and answer session. It could be about anything at all. You just let us know what you need. And yeah, I look forward to speaking to you soon. Take care and have a good rest of the week.